Welcome to Markets Now. I'm Michelle Rook along with Darin Newsom, Senior Market Analyst with Barchart. And we're seeing higher prices, except for corn has taken just a little bit of a backseat this morning. And Darin, let's talk about this week because big sell-off in the grains to start the week. We saw some recovery yesterday, except for the July corn futures. And, is it all about weather at this point?
I think there's a lot going on, Michelle. Certainly, weather's playing a role in some of the new crop markets, but that July corn contract was fascinating as we started the month on Thursday. We saw it run up to 606 with its 50-day moving average, a technical indicator, up at 605. And the minute it hit 606 through Friday morning, through the overnight session and Friday morning, it dropped more than 20 cents. And so, the market just collapsed. It's like it triggered a bunch of selling. Now, initially, my blink reaction to this, it certainly looked like that could be the result of some possible Chinese cancellations. We haven't seen anything. Hopefully that wasn't the case. I'm also hearing from folks out in the country that, that basis is starting to weaken. Now, my national average basis calculation actually strengthened Thursday evening, but what I'm hearing from folks is that basis is actually starting to weaken across the Central Plains as farmers are starting to clean out their bins, heading into summer, getting ready for the fall harvest. They're taking advantage of the strength of basis. They're taking advantage of where the futures market is right now, overall cash price. And that could be starting to put some pressure on July as well.
Okay, so I buy that cash movement, farmers selling, that sort of thing. Could it just be unwinding of some spreads too? Because, man, the July SEP, the July, even December spreads have been pretty wide.
Yeah, they have. July, there's a reason July's got this inverse to SEP and DEES, and it's the fact that old crop supplies remain tight. It did my month-end available stocks to use, and it tightened ever so slightly from what we saw at the end of April. So we know old crop supplies are still relatively tight. They've loosened a bit, but they're still relatively tight. Now, September this year, because of the early pace of planting, because of early weather and so on, September, that hybrid contract's actually more of a new crop issue. So what we're looking at here is that SEP-D spread, which has moved into a small carry, and it's kind of flattened out. And we still have a weak carry going on in the DEES March and so on. So, longer term fundamentals are still bullish. They're not as bullish as they were for the 2021-22 marketing, excuse me, the 22-23 marketing year. But as we look ahead into 2023-24, there's still some concern over production. We've seen, soil moisture is still an issue across the Midwest, even more so than it was last year. So, this 23 crop is not out of the woods. We just have to get through this early June timeframe and see if we can get find some buying to come back into this market.
Yeah, that's why I asked about even December corn yesterday. We had the drought monitor come out. We expanded drought areas. And if we were trading weather and drought concerns at this point, it's not about exports because exports were pretty dismal this morning, weren't they?
Yeah, we're just, we haven't gone anywhere with exports, for much of this marketing year. And it just, this last quarter, I don't see anything really picking up. We're still running, as far as total sales go, I think we're something like 36% behind last year at this point. Shipments as a whole are running well behind last year's pace. I just don't see that changing. Again, my concern was when we saw what happened with July on Thursday and again overnight through Friday morning. My concern was that we could see some possible cancellations by China. But again, they only have 40-some million bushels still on the book. So there's still room for them to do something. We just haven't seen it yet.
Right. So exports weren't that good for soybeans either. We're falling behind the year-to-date pace compared to last year there as well. So what's holding up the market this morning? Is it the fact that we did have a strong crush report out of NASS yesterday, or is it soybean meal and oil are higher? So is it just a function of we got too short maybe, or we pushed too hard one way and now the products and soybeans are all coming back technically, or what?
I think there is a little bit of a technical play going on in soybeans. We haven't, in corn and wheat, we saw some bullish reversals occur at the end of May that we didn't see in soybeans. But on the weekly charts, on the intermediate term charts, we could here today, depending on what the soybean market, how it finishes off the week. So I do think there's a bit of a technical play going on. And as you mentioned, from a fundamental point of view, I think it all has to do with the products, particularly soybean meal. We are starting to see an increase in demand. Crush has been consistent so far, still running on pace with maybe just a little bit ahead of last year. Exports, as you said, with the latest sales and shipments update, we're on pace with last year, but it's nothing spectacular. And total sales are actually 14% behind. So that to me is an issue. I don't think we're going to be making any more sales the rest of this marketing year over Q4. It's going to be very small. So I don't think we're going to gain any ground on last year. So I think we're still going to come up a bit short. And so that certainly could weigh on the old crop market, over the next few months.
Yeah. All right. Same question for the wheat market, because exports weren't good there this morning either. We saw cancellations in old crop, and new crop was, a little slow to start off the year. But what do you think's driving that market right now?
Right now, I think there's a number of issues. We have harvest just beginning in the winter wheat markets, but I think one of the kind of the quieter factors that's going on right now was early this week, or is late last week, early this week, we saw the July-September Chicago spread move to covering 82% calculated full commercial carry, and this brings the possibility of variable storage rates from the CME into play later this month if the running average is above 80%. So the minute that we did that, we started to see, it immediately started to back off. As of Thursday's close, I think that spread was back to something like 75%. We saw some strength coming into July. Now, there's a lot of things going on. Number one, we've got funds rolling. So I know they're short right now, but if they're changing their positions, they could be buying back the July and selling the September, which is going to skew the spread through the early part of June. Might not necessarily be a good fundamental read, but because it could certainly skew that July SEP spread. So we got to look out to the SEP Ds, which is also running, above 70% calculated full commercial carry as of Thursday's close. So I think there's some things going on. I don't think merchandisers really want that variable storage rate coming into play. If it does, later this month. I think right now they're going to try to avoid it.
And cattle, more new contract highs this morning. We're seeing follow through, some all-time highs on the futures in the front month, and it's been pushed by what looks like it's going to be a record week in terms of higher cash trade.
Yeah, there's just no stop in this market right now. Nobody wants to sell it. I mean, I had a good friend called in. It was when December was trading about 175, and he said, "Okay, what's going to come first, 170 or 180?" My hunch was, we'd back off a little bit, see 170. Little did I know, the very next day, Dees would be pushing up against 180. So there's just nobody wanting to sell this market right now. Cash market remains strong. Boxed beef market continues to go up. Strong labor market continues here in the U.S. They're not afraid to buy higher priced beef. Demand remains strong. Just a lot of bullish factors. At some point, it's going to run out of gas. I have no idea when that might be. Right now, it just wants to continue to go higher.
I know, but you have some people that talk about, like yesterday, as a blow off top. Well, today, if we get follow through, that negates that argument, doesn't it?
Yeah, you also have folks that like to step in front of trains for fun, step in front of runaway trains for fun. I'm not ever going to call anything a blow off
Gotcha.
top. I mean, that just tells me that you're in the wrong position, that you're short the market. These things, the trend's going to continue to do what it wants to do until it changes. We won't know when it changes. We might get a sign on the charts. But other than that, it's best just to ride along with it. Don't step in front of it and just let the market run if it wants to.
Let's talk about some of the outside market factors. We did get the Senate voting positively on a debt ceiling extension, and so that deal is done. That's a good thing. We also have an OPEC meeting coming up, and we had jobs data out this morning. So talk about what the market is looking at there.
Okay. The idea that the debt ceiling, was going to get done no matter what. I mean, it was a political game being played. There was no doubt that it was going to get done. And if it didn't get done on time, we would simply just extend the deadline. That's all that was going to happen there. I think all eyes are kind of on OPEC right now. From what I'm reading this morning, there are some unnamed sources saying OPEC will not be doing production cuts. I find it a bit of a surprise given the pressure that both the Brent and West Texas Intermediate crude oil markets have been under. We'll see how this weekend plays out. And as for the labor market, again, we've been seeing strong numbers. The biggest question is, do we believe these numbers at all? I mean, they are government numbers. And what I get the biggest kick out of is how far off these pre-report estimates are. You really have to wonder what these folks are doing when they make these guesses ahead of time.
So what are your leading indicators that you are watching in the marketplace that tell you that this jobs data is not accurate?
I'm not saying it's not, because the economic indicator I look at is box beef. Box beef is still strong. We're 37, $38 over a year ago, in box beef, both choice and select. So, what we know, the labor market's strong. Do I know what the actual numbers are? No, I wouldn't even pretend to. And I don't think anybody does, but it does show me that the labor market's still strong. Consumers are not afraid of higher priced beef. They're still buying. It's that time of year as well. It's grilling season. So, demand is going to remain strong. And as long as people have jobs, as long as people are going back to work, they're going to spend some of their money. It looks like right now they're going to continue to spend their money on higher priced beef.
Yeah. Well, if there's a recession out there, I haven't seen it in the grocery store. That's for sure. All right. Always fun to talk to you, Darin Newsom, Senior Market Analyst with Barchart. That's Markets Now.